coming to you live this morning from the roof of our Fox Business Network studios overlooking New York, where, of course, it is primary day. We are highlighting the Empire State in the backdrop. But first, U.S. futures pointing to a higher opening this morning after the Dow Industrials crossed 18,000 for the first time yesterday since last July. Earnings rolling in this morning, including Johnson & Johnson, which you just saw on the screen. Earnings in the first quarter at $1.54 a share on $17.5 billion in revenue. Joining us right now is Merrill Lynch Wealth Management Portfolio Strategy Head, Bartels, here on set. Marian, good to see you.
Great to see you, Maria.
We've been talking a bit about earnings. We talked about Netflix, and we've got the CFO of IBM coming up in a few minutes. How would you characterize the first quarter earnings season so far?
Well, so far, I think the market is set up for some expectations that are better, because we were really looking for earnings to come in, or at least analysts were looking for earnings to come in down 9%. You have to remember, earnings actually have been in a recession. We've had negative earnings growth rate. And what the market's going to be looking for is whether or not it's going to be another third quarter where at the end we have negative growth rates. We actually think we have the ability to trough here, but this is the week where we get a bulk of earnings, so it's a little bit too soon.
Yeah, we're going into this peak period, but we were having a debate earlier, John Hilsenrath and Sandra and myself, talking about oil or earnings. What do you think it is that's stabilizing this market? Because we're talking about 18,000 again on the Dow Jones Industrial Average. Is it because oil's back above 40, or is it actually the backdrop that earnings are looking okay?
I think the market is wrong looking at oil. That's the old bull market. It's really about how are companies going to build their earnings. And it's not just about earnings, Maria. It's about top-line revenue growth. And you're seeing a lot of companies come in and beat, but they're not beating on the top line. So I think the market will look at both.
So, Marian, tell us, what kind of market is this? We spent a lot of time in the first quarter talking about a bear market. You know, every few days we got bad news out of China and the market tanked, and it looked like, you know, people worried we were going back to 15,000. Now,
especially early in the year,
weeks,
that was like a panic.
Monetary policy is easy, and we're up over 18,000. It seems like a schizophrenic market. Do you think this is one that's fundamentally going up, or is it fundamentally going down?
You say schizophrenic, we say episodic volatility.
Tomato, tomato.
Exactly. So we think it's going to be a choppy market. We think it's going to be a sideways trading market. We've also called it the buffalo market. It sometimes gets a little lazy and can lay down, and we think the market could be ripe going into May, where we actually get a pause.
Okay, so my dad, who's watching this at home right now, where can he expect it to be by the end of the year?
Hello, Dad Hilsenrath.
Actually, we think the market can end up...
It's all about Dad. You know, get in the right place.
And Mom. Don't forget about Mom, too.
My mom's watching, by the way.
So we think the market's really going to have a flat year. Our year-end target we've already surpassed. We think it's 2,000 on the S&P, but that doesn't mean that there's not opportunities within the marketplace. Our clients really need income, and they also need growth. And when you compare the equity market to the bond market is extremely expensive. The equity market is much more attractive, particularly with yields higher than 10-year treasuries on the S&P. So if you're looking for pockets of the market, there's growth in technology. We think consumer staples would be a pocket to look at, and some select industrials.
Okay, so you buy dividend-yielding stocks, you pocket your 2 or 3%, and then you say, that's what I got to live on.
So hold on. I'm asking a question for Daddy Hilsenrath. So let me jump in here, because we're looking at the Dow right now, Marianne, just below 18,000. The market all of a sudden gets really popular on Main Street and with folks like your dad when we hit record highs. Let me remind everybody that the record closing high is 18,312. That was May last year. If all of a sudden we're a stone's throw from there, if all of a sudden we get there and go above there, do you get a flood of new investment into the stock market?
Well, let's remember, the market is at the same PE multiple when we were hitting a high last time when we sold off. The market is trading at 19 times earnings. You're actually priced for perfection.
So that's expensive.
That's a little bit expensive.
It's trading at very high multiples with exceptionally low interest rates. So when rates are so low, we should have high multiples.
Right, so where are the alternatives if you can't get any return?
Right, there really is no alternative. The term that the Wall Street is using is TINA, but the markets did sell off even in a low interest rate environment. Let's also look at the Fed maybe raising rates in June, and the market's going to have to face that. We also have to face Brexit, so we think we get episodic volatility.
Hold on, quick correction, because I was quoting the futures market just below 18,000 as we speak.
Right.
But it closed above 18,000 yesterday, so we're right there.
It sure did. Real quick, anything out of the ECB this week?
I'm actually looking past the ECB to the Bank of Japan a week after that. We could see another set of easing measures out of them.
All right, Marian Bartels, John Hilsenrath, good to see you both. Thank you. We'll be right back.